And it's now time we shift gears to yet another very interesting segment, which is a fireside chat on Innovating Credit, a founder's playbook for building a lending fintech. Well, building a successful lending fintech requires both balancing innovation and, of course, with compliance while identifying and serving the right customer segments. And this fireside chat will explore strategies for scaling a lending fintech with transparency, affordability, and keeping trust at its core. So, first up for this fireside chat, may I please welcome on stage the co founder and chief executive officer at paisabazar.com, Mr. Naveen Kukreja. Let's put our hands together, everyone. Warm welcome to you, sir. And to spearhead this conversation, may I please invite the co founder at the Digital Fifth, Mr. Sreekant Rudrabhatla. Warm welcome to you as well. And we're really looking forward to this chat. Over to you, sir.
Welcome, Naveen. Welcome to this interesting session. I think coming in right immediately after the co-lending session, right, it's an interesting take on how things are shaping up. Just a quick context. I think fintech and lending has been on the growth for quite some time before the regulators decided to come with some guidelines. So the last 1 year, we've seen a lot of interesting developments happening in this space. Fintech is still a lot of, everybody's focusing only on the lending side because that's where mostly the monies are made. The rest of the segments, one still has to evaluate and see how things are going to play. Some interesting insights, what I just kind of checked before I came and we were discussing, right? Around investments have come down in the fintech space by around 19%. Number of deals apparently have went up by 23%, and mostly going towards the SaaS side of it. Given that, our topic is like how do you build a playbook for building a lending fintech, and you are one of the architects way back in 2014. So maybe if you can introduce yourself to the audience, you require no introduction, but still there are always the new entrants who wants to know how you planned it, how you scaled it, and then we take the discussion forward from there.
Thank you, Digital Fifth, and thank you, Sreekant, for inviting me. Like you mentioned, I co-founded and run Paisabazar, which is a marketplace for lending products, part of the PB Fintech group, which also runs Policy Bazaar, which is a marketplace for insurance products. The company, original company was founded in 2009 actually, is when Policy Bazaar started. I joined the firm in 2014 to set up Paisabazar. We at that point also saw, given my experience in financial services and given that I had worked in UK, which was considered at that point the most mature and developed market for digital acquisition or digital lending, I saw the scale at which the ecosystem can operate once the ecosystem matures. For example, when I was in Capital One, which is a US-based bank, I was in the UK business. About 70% of Cap One's new acquisition was driven by digital, and of that, about half of that was driven by marketplaces. So I saw the scale potential there, and that's where the idea germinated. Of course, I came back and worked with Aviva, etc. But when Yashish, who's the founder of Policy Bazaar, he and I spoke, I thought it was an interesting opportunity, and at the right time, given that the country was coming on the back of recovering from the global financial crisis and building out the unsecured again. I thought that was the right time to start building out a platform or a business in lending which works as digital first, and digitization as it happens, we will evolve. And some of that is something we've seen over the last, it's been 11 years. We've seen that as the ecosystem has evolved, matured, and when you take a 10-year, 11-year view, you can see how far the country has moved in terms of whether it's a credit bureau, which was relatively new in the pre-global financial crisis era. I remember 2004-05 when we used to give out credit cards without even looking at the bureau. That was the norm of issuing unsecured credit. to 2014-15 when Credit Bureau really became meaningful, 12 onwards actually, or whether it was digitization and internet access driven mostly by, I think, the transformation that Geo caused in the country, or it was launch of or meaningful kind of expansion of Aadhaar, which became the base for digital stack and identity verification, and now more increasingly where the digitization of financial data is happening through account aggregator. So that, I think that was the core base of why and how we started. Just for context, we now have about 50 million, we're just touching 50 million consumers who've accessed our most popular product, which is the free credit score product, on the back of which we, of course, we're able to engage with the consumers and then able to cross-sell. So we feel very proud and good about the fact that we managed to create some sort of an impact in the lending industry and tried to do our best in terms of making it convenient for consumer, but also hopefully take the ecosystem a little forward.
You've been very modest, and you've not made some impact, you definitely have made a lot of impact there. But just one quick follow-up question from what you started, right? Marketplace model bringing to India. If you look at how, my understanding of how at least the fintech has...
Mic closer.
Pass me? Okay. How this entire lending space has evolved here, right? From fintechs trying to build their own books to now being limited to a limited 5% of exposure. So I think they are also kind of pivoting more towards a kind of a LSP, so-called digital DSA kind of a thing. So how do you think that's going to affect your business in the long run? And if somebody has to actually replicate building a marketplace model and somebody has to get in, what do you think the key requisites for them? Sure. From a people process planning to a funding, how difficult it is or how easy it is, and what they should be cognizant of, because given the guidelines, I think that's the route.
Sure. Couple of complicated questions you've asked, Sreekant, so I'll try and separate them.
So then I can take a pause and then I can give you the
So as a context, I mean, we're from fintech. I'm assuming everybody is from fintech or financial services. So as a context, we all know that India continues to be fairly underpenetrated. The household debt to GDP ratio is still at about 17%, if I'm not wrong, compared to a developed market where it's in the range of 60, 70, 80%. You look at credit cards, it's still about 60, 70, 80 million, 90 million maybe, which is about 5-6% of our population. You look at the unsecured lending, that's also fairly underpenetrated. And then you look at that data point, and then you look at what's happening at the macro level. The economy is growing at about 7% or so, real terms about 11-12% on nominal terms, and hopefully that growth continues. And if the economy overall grows at that level, that kind of uplifts the people from a certain income to the next level where they become lendable, if I could use that word, and more people come into that. So currently, if you look at the lendable population especially for banks, it'll be thereabouts of 100 million, plus minus 20-30 million. And over the next 10 years, the hope is that population, that segment rather, will expand to about 250 million or so. And you look at that kind of opportunity, and given also what's happening, like I talked about, whether it's bureau, whether it's getting digital infrastructure together, whether it's getting digital data together, and now most recently AI, in terms of how it can add more efficiency to the processes, etc. I think there is a lot of headroom for the entire country and the ecosystem to grow. There is a lot of consumers that we as an industry need to reach out to and service. Another data point I'll share is that for every, we get a lot of inquiries and we have access to bureau data, so we are able to see that. For every loan that's disbursed, there are about 3.4 people applying, which just shows you on how underserved the market continues to be. And hence, if the ecosystem needs to go from point A to point B, I think there'll be various models that will have a potential as long as the company who's building it out is very clear on fundamentals and first principles. And you talked about the people moving from balance sheet to FLDG to distribution. We are totally in the distribution model. We don't even do FLDG. We don't take credit risk. And hence, our model of being a very, very transparent marketplace is slightly unique. Of course, somebody new can come in. There's no problem in that. There is enough market. But a lot of people, you're right, have played between, they want to be a lender in their hearts, but have oscillated between balance sheet versus FLDG. And that I think is primarily because the capital markets continue to be fairly underdeveloped. For all NBFCs, the primary source of capital continues to be bank. And the banks also in the last 12-15 months have tightened their purse strings, driven by the unsecured growth, driven by the regulator guidance, driven by their own kind of internal priorities. And hence, I can see some people may have taken that path. But I think again, if we kind of expand that to the next 5-10 years, people will be able to kind of build businesses. I'm aware of certain fintechs who are trying to build out balance sheet business, and they're doing it very carefully, and they will be able to do well. So various people can do well in various models, whether it's B2C, B2B, just because the overall ecosystem has to move massively up for the country to do well. And then you asked the second question around what could the startups look at. Is that something we should address now? Or? Yeah.
So, 2-3 pointers again taking from your response, right? One is the distribution aspect of it. Okay, and you said you do the customer segmentation and there's largely underpenetrated and all of that stuff. One interesting aspect is, this is at least my understanding is, your customer segmentation vis-a-vis the regulator's customer segmentation, I think it always differs at cross purposes. They're always more concerned about unsecured lending versus secured lending, and the NPAs and all of that stuff. So when you, how do you work? When you do your supply and demand and supply kind of management on your product portfolio, how closely do you work with all these bankers or all these distribution guys in terms of building the right product mix? What's your involvement? What kind of inputs you give back to them to build the right products?
Sure. I'll just try and address the unsecured piece a little bit. Again, if we go back and look at last 12-13 years post global financial crisis, you look at a period from 2012 to 2021, the overall, and if you look at the credit growth period, overall credit was growing at about 14-15%. Unsecured possibly was a little higher, but was in the 15, 16, 17 range, maybe 18%. And secured was a little lower, but that was a ballpark range over a long period. What happened post-COVID was that the entire industry and the country, everybody got a relief that things didn't turn out to be as bad as everybody had feared, starting from the banks, NBFCs, to the credit ecosystem. And so everybody went super aggressive in 2021. We saw that in our growth also. We grew by 98% in one year, we grew by 78% in another year. And the entire industry, the unsecured piece, grew by about 33% in that 3-year period. That data is fairly public. And I think that is what caused the regulator to worry, because that was not a holistic growth or a sustainable growth. That of course was driven by the consumer ecosystem doing really well. The country did not get impacted, as well as a lot of new capital came in. Not necessarily venture capital, but also domestic promoter capital, if I could call it. Large businesses who had lots of positive cash flows in non-lending businesses, whether it was manufacturing, whether it was telecom, the players I'm hinting towards. They saw lending as a great opportunity. They came in, and hence the supply increased quite a bit. Yep. And that led to much higher growth. And that's where I think the regulator stepped in and tried to kind of moderate the entire industry growth. Of course, warn various players. They kind of started with advisory, then they started looking at individual players. And that has resulted in a fairly tough period from a last 12-15 months perspective. But coming to what we do, and of course, because we are a marketplace, we get about 8 to 9% of the entire inquiries in the country on unsecured come through our platform. So we have a fairly large base, and it's a fairly representative base. We get inquiries from about 800 plus towns. What we do, of course, from the very beginning is we have tried to figure out how do we become the most sustainable and cost-effective channel, acquisition channel for our lending partners. And when I look at unsecured only, we actually don't look at it as one lens. We divide it into 5 or 6 different segments. So you look at salaried, there is super prime and prime, which is essentially banks and very large NBFCs play area. Their requirements are very different. You look at the medium size NBFCs, they look at what I call as near prime to low end of prime. And then we have fintechs or newer NBFCs who look at subprime, repaired credit, new to credit kind of segment. So we try and work with these individual players, understand their credit, and then you look at the self-employed segment and similar kind of segmentation, right? Banks to SME focused, large NBFCs to smaller NBFCs. And it requires working independently with these guys, understanding their segments, understanding where in the funnel is our customer segment coming. And that's one of our advantages, or has become one of our advantages over a period of time, that from the top of the funnel, the number of people we are able to show an offer to, it would be higher than even the largest bank in the country. It should be, because otherwise we are not doing our job. We are able to work with different players in each segment, understand, and in some cases we have co-created products with them. And a co-created product essentially means that we run through the entire course of the loan and have spend-based or payment-based payouts linked to our payout, which is putting our skin in the game, and hence also allows us to learn and grow in the process. So we work kind of in a very nuanced fashion in that sense.
Excellent. So again, now connecting it back to our topic, you have a decade-long data to co-create and stuff like that, right? And today, given digitally penetrated, digitally native guys who are looking at more customer experience and all of that stuff, if somebody has to start that journey of building a lending fintech without the data insights, what do they do?
Actually, if I think about it, two fundamental things about lending that I have learned, that there is almost no advantage of being a first mover in lending, because the first movers usually make a lot of mistakes, and you can learn from those mistakes of individual players but also industry as a whole. So if you're starting now, it's possibly the best time, definitely better than 2014, definitely better than 2018. The best time also because a lot of ecosystem is getting digitized. A lot of venture funding has gone through a cycle, so it's available, but it's also more wiser. There is no blind capital coming in, and also you've seen a cycle. If you hadn't seen a credit cycle in global financial crisis, you have seen some sort of a mini cycle, partly in COVID, but not so much in COVID, but in the last 1 year. And I think it's very important if you're getting into lending that you've seen some cycle. That wisdom cannot be borrowed or learnt by reading or looking at somebody else's data. So if you were anybody was getting into lending, first of all, it's a great time. You as a new player have actually access. Especially if you're a regulated entity, you have access to the credit bureau data. You have increasingly access to the account aggregator data. You have access to technologies around KYC, around identification of customers, around fraud. Fraud is kind of work in progress. My advice would be 3-4 things that, of course, you have to be very, very clear. Like I said in the beginning, there are lots of opportunities, and there are micro segments where the opportunities are available, and if the country has to do well, the entire ecosystem will do well. You have to be very clear on first principles basis on which segment are you solving the problem for, and the problem is a real problem. And secondly, the problem that you're solving and the core business, how would it make money? It ideally should be making money from the beginning, but as long as you're clear that it will make money in the core business itself, at some point in time, there might be some investment period, then that gives a lot of clarity. The second piece I would say is that India, there is a large opportunity, there's also a lot of competition. The human capital is one of our biggest strengths as a country, but also if you're in a startup ecosystem, it's also very competitive. So the deeper you can go into your area, the higher the chances of success. The problems will get solved as you go deeper. If you are horizontal and at a high level, you will need a lot of capital to try and become meaningful. But if you are going deep, it'll become far easier at a certain point in time. And a couple of other things which I think are important for somebody who's starting out now is the initial set of co-founders and the core team that you're building. I was very lucky in that sense that when I hired my core team, I remember at least for the first 50 people that I hired from 2014 onwards, none of them came through consultants. All of them came through my own references or then the people who I hired. And I met with another founder today. He said something similar. I was very happy to hear that a team of 45 only, he said, we have not paid 1 rupee to consultant. I think that's a great way of building the initial core team and co-founders, because they will, when you're building out something, there will be lots of downtime. And if you have people to consult with, people to cry with, people to solve problems with, I think that makes you much stronger. And lastly, I think that's not not restricted to fintech. For any startup, that when you're starting out, have at least a 2-year runway in terms of capital. 2 years is a fairly random number. It could be 3, it could be slightly lower, but 2 years of runway, capital runway, essentially ensures that at least for 1.5 years, you can really get down and focus on solving the problem instead of trying to figure out and scamper to raise capital. If that requires you to invest, raise capital from external, do that. But I'm also aware of a very, very good startup that I met just now outside, who has been around for since 2016, completely bootstrapped, now at a 20 million revenue run rate. But do have adequate, and 2 years is a kind of a line in the sand of capital runway, so you can really spend some quality time, and at any point in time have 2 years kind of runway, so you can focus on building the business instead of raising capital only.
Excellent. I think all the tips you gave, we can fully echo with it. Hiring from the known references, being bootstrapped, having that runway. I think one last point is you get a family buy-in also. When you're getting into this side of the segment, I think we'll have time for one question or two questions. Anybody from the audience, quickly. Yes, ma'am.
You can ask the question to Sreekant also. He hasn't answered any question in the session.
Hi, I'm Sucharita from Equifax. My question is to you, Naveen. Paisabazaar so far has been focusing on the marketplace model, but I believe recently you've also shifted your focus to the physical distribution channels for secured lending. What's your vision around that, and how do you plan to address the problem of being close to your end customers? Because in a physical model, that's very essential. Thank you.
Thanks for asking that. Our core model remains the same, which is a marketplace. So far, till March of this year, our strategy was, the consumers anyways are coming digitally on our marketplace, but our strategy was to fulfill those also digitally. And that has played out, and that's been our strategy from the very beginning. That has played out very nicely in unsecured loans and credit cards. Credit cards, almost 100% is now digitally fulfilled. personal loan is a good mix. More than 60% of the loans are getting digitally fulfilled. There are some offline process components, but they are increasingly going away. And my view is that in the next 3-4 years, it will be entirely digitally fulfilled, especially as the account aggregator becomes more meaningful. Our phygital strategy for fulfillment is more for secured. Secured for us was very small, and one of the reasons it was very small for us was because we were only digital. And secured, as you are aware, especially home loans and LAP, is a very, very offline heavy. Then the core product, underlying product, needs to be assessed, valued, verified physically. There will be a time, sometime in future, but not in the next 5 years, I think, where even property verification, etc., can happen. Valuation, assessment, verification can happen digitally. At some point, we'll get there as a country. But till then, it's a very, very physical process. And when the consumer needs to go physical or the lender needs to go physical, there are lots of breakage points. And there are lots of leakage points from our perspective. So we decided to plug those leakage points and build our own fulfillment. And that's a strategy to scale up secured. That part is scaling up really, really nicely for us also. But that's more a fulfillment and a secured category strategy.
Thank you.
Thank you. Thanks, Naveen. Thanks for this wonderful session.
Thank you so much.
Look forward to hosting you again.
Thank you. My pleasure. Thank you. Thank you, everybody.
Thank you. Thank you so very much. Can we have a louder round of applause for Mr. Naveen Kukreja and Mr. Sreekant? Thank you so very much for driving such a wonderful conversation right there. May I please request Mr. Sreekant to felicitate Mr. Naveen with a memento, a token of appreciation. Can we please have the memento on stage? Well, I must say that that was not just a fireside chat, but I believe that was a masterclass in itself. So round of applause for both of them one more time. Thank you so very much.